What if I told you that you only need 3 investments for the rest of your life? No stock picking, no timing the market, no stress, just 3 ETFs. That is it. This is called the 3-fund portfolio. It is simple, it is cheap, and it works. Today, I will show you exactly what these 3 ETFs are, how to put them together, and why this is probably the only investment strategy you will ever need. Let us start. Why 3? Why not 1? Why not 10? 1 ETF can be too simple. You might miss important parts of the market. 10 ETFs can be too complicated. You end up overlapping and overthinking. 3 is the sweet spot. You get full diversification. You cover the entire world. You own stocks and bonds. You pay almost nothing in fees. This strategy was made famous by the Bogleheads, followers of Jack Bogle, the founder of Vanguard. They proved that 3 ETFs beat most professional investors over the long term. ETF number 1, Total U.S. Stock Market. This ETF owns every public company in America. The big ones like Apple and Microsoft, the medium ones, the small ones, all of them. By buying this one ETF, you own the entire American economy. The most famous versions are VTI from Vanguard, or ITOT from BlackRock, or SCHB from Schwab. They all do the same thing. Pick any one. This should be the biggest part of your portfolio, about 50 to 60%. ETF number 2, Total International Stock Market. America is great, but the world is bigger. This ETF owns every public company outside the United States, Europe, Japan, China, Canada, emerging markets. By adding this ETF, you are not betting only on America. You own the whole world. The most famous versions are VXUS from Vanguard or IXUS from BlackRock. This should be about 20 to 30% of your portfolio. ETF number 3, Total Bond Market. Remember our video on bonds. Bonds are your shock absorbers. They protect your portfolio when stocks crash. This ETF owns thousands of bonds from the U.S. government and American companies. When the stock market drops 30%, your bonds might stay flat or even go up. This keeps your portfolio from crashing completely. The most famous versions are BND from Vanguard or AGG from BlackRock. This should be about 20 to 30% of your portfolio. More if you are older or closer to retirement. Less if you are young. Here is a simple example. You have $10,000 to invest. 50% in total. U.S. market. That is $5,000. 30% in total international market. That is $3,000. 20% in total bond market. That is $2,000. Once a year, you rebalance. If one ETF grew faster than the others, you sell a little and buy the ones that fell behind. This keeps your risk level the same. That is it. You do nothing else for the whole year. No checking every day. No panic selling. No trying to time the market. Why does this simple strategy work? Because you own everything. You never miss out when one part of the world does well. Because you pay almost nothing in fees. These ETFs cost less than 0.1% per year. Because you do not make emotional mistakes. You have a plan. You stick to it. Studies show that this simple 3 ETF portfolio has beaten most professional investors over the last 20 years. Not because it is smart, because it is disciplined. Let us recap. ETF number 1, Total U.S. market, 50 to 60%. ETF number 2, Total International market, 20 to 30%. ETF number 3, Total Bond market, 20 to 30%. Buy them, hold them. Rebalance once a year. Ignore the noise. That is the lazy investor portfolio. And it works. In the next video, we will look at dollar cost averaging versus lump sum. Which one is better for you? For now, remember 3 ETFs. That is all you need. That is all for today.